I mean, starting off with the bond market, the EuroBond performing quite interestingly since the beginning of the year, since it was launched. Give us an update on what we have been seeing and in terms of foreign participation.
Yeah, well, actually the Eurobond rallied in the first few days. The yield went from 7% to about 6.7%. And last week the yield trended upwards and it came back to 6.98%. And what's interesting here is that if you look at the credit spread of Nigeria, actually it has declined to about 330 basis points from 335 when it was issued. So it means that actually in terms of risk profile, the country has performed well. But the issue is that US Treasuries have rebounded. You know, the Nigerian Eurobond is based on the 10-year US Treasury, and the yield on this one has actually increased to about 3.65% from 3.4% when the Eurobond was issued.
Well, you mentioned some interesting factors there. You're talking about Nigeria's risk profile being in good stead. Tell us about how it fares relative to the likes of Gabon or Ghana's Eurobond, and also just looking at the US Treasury scenario. We have seen a lot of optimism coming to the fore. We still have a very strong stimulus package in the US, so that should soak up a lot of the US Treasuries as well. Clearly a lot of factors to take into consideration in terms of forward looking how the Eurobond in Nigeria will fare going forward.
Yeah, well, first of all, actually Nigeria has performed very well compared to other African countries. If you take the case of Gabon's Eurobond, for example, the credit spread jumped by 70 basis points to about 315 basis points as of last Friday. In the case of Ghana, there was an increase by 25 basis points to 369 basis points also on Friday. So clearly Nigeria has outperformed. And I think the key difference between Nigeria and the two other countries is that there's been a lot of onshore demand for the Eurobond here by financial institutions. And also if you look forward, actually the pension funds are now allowed to invest offshore. There are still some issues in terms of global custody, but that should be solved in a few weeks. So there will be extra demand for the Nigerian Eurobond going forward. In terms of US Treasuries, well, I think they increased because there was a sharp fall in the unemployment rate, and that figure was released last Friday. So the fact that the market now expects some better economic data going forward would actually place some upward pressure on the US Treasuries. But that said, we don't think that it's going to reach the 4% level for the 10-year US Treasury. So it's going to be marginally up, but not substantially.
Let's touch on local currency bonds in terms of performance going forward as well. We had the Central Bank of Nigeria interest rate hike by 25 basis points. Clearly, this could be an issue going forward. The supply-demand scenario in Nigeria also remains to be seen going forward, because we are starting to see quite a bit of supply. Do you think demand is going to catch up to all the supply that we've seen?
Well, first of all, actually, the impact of the hike has not been that substantial on the yield curve. True, rates went a little bit up after the 24th and 25th of January, but they've started to come down. For example, the 20-year bond went to 13.5%. It's now back to 12.9%. And I think it's actually because of the demand-supply outlook. It doesn't look that bad. The Debt Management Office plans to issue 865 billion Naira in bonds this year. That's down from 1.18 trillion in 2010. So the aggregate issuance would be down by about 27%. Just to give you other figures, for example, in the first quarter of 2011, the planned issuance is about 865.5 billion Naira. That's less than what the DMO actually raised in September 2010 alone. So clearly the fact that there's less supply has contributed to the downward trend in yields. And another thing to keep in mind is that on the 1st of March, the liquidity ratio will be increased. And that means that the banks, some banks at least, will have to buy more bonds. And I think that's going to be positive for the bond market.
So clearly demand coming through there. Let's look at some of the risks going forward. Inflation is something that we are talking about extensively since the beginning of the year. It is impacting emerging market economies extensively, with the inflation figure for January set to be released soon in Nigeria. What impact could this have on the yield curve?
Well, I think at the longer end of the curve, it could have an impact if there is a substantial increase. But that said, inflation has been going down for 4 consecutive months. It reached 11.8% in December. And there is little reason to believe that there's going to be a substantial turnaround in January. But that said, as you pointed, actually inflation is going up in most emerging markets. So clearly the risk is still there. I think the difference between Nigeria and other countries is that here the CPI was revised upward, so new time series were released in August 2010. So actually you don't have this low base effect as in other countries. So even though there might be some inflationary pressures driven by exogenous factors such as higher energy and food prices, it's not going to be that substantial here.
Well, what about importing inflation? This is something that we are going to be experiencing in the likes of South Africa as well, with a slightly weaker rand. And looking at the Naira, it has been range bound, and we're seeing in that very tight range of 3% or so. Looking at imported inflation down the line, are you confident that inflation, and of course you mentioned the factors as to why Nigeria is very different to other emerging market economies, that it can be sustained and it can go down to single digit into 2011?
I don't think it can go to single digits in 2011. That looks quite unlikely based on the time series that we have at present. But that said, I think it can be contained between 11 and 13%. The problem with imported inflation is that actually, it's very hard to fight it with interest rate decisions. And so the ability of the central bank to do anything about it is quite limited. That said, if there was some fiscal consolidation in 2011 and the currency appreciated a little bit, I think it would have an impact on exogenous inflation. Let's just remember that in 2007, inflation in Nigeria was 5.4%. And at that time, the Naira actually appreciated to almost 117 or 118 at some stage.
Let's touch on the oil price. And yes, perhaps oil prices are bad for inflation, but great for Nigeria. I'm looking at the crude accounts as well. Their Bonny Light oil prices trading at around $100 a barrel. Of course, we have seen Brent crude, though, breaching that $100 a barrel now, because we are starting to see the tension subsiding in north of Africa and those countries there. Your view on this and how it's going to impact the FX market going forward?
Well, I think it's very positive. First of all, it means that the country is going to post a substantial trade balance surplus, as well as a current account surplus. We think probably close to 20% of GDP. It means that the central bank will have more flexibility in providing dollars to the market. And actually, that means that the central bank will be able to maintain the exchange rate at plus minus 3% around the 150 level. In fact, if the fiscal position wasn't that loose, there would be even an incentive to let the currency appreciate. But I think we're not there yet. Another interesting point is that besides that, the central bank has tightened liquidity since last September. And that's starting to have an impact on FX demand. I mean, FX demand has been below $300 million per auction for the last 3 auctions. And, it's quite a positive turnaround. The other thing is that you also have more supply on the interbank FX market.